All right, yield nerds, this is the part where we put all the previous lessons on value investing together and create a thesis and identify a path forward. Couple of quick things before we get going. My usual disclaimers. I am not giving you investment advice. Invest at your own risk. I am sharing my lessons. I'm not a wealth management advisor. I do not have sponsors and I don't have merchandise to sell. And I certainly am not one to tell you about politics or products. Okay, couple of quick things on the agenda of how we are going to do it. We're going to look at the two foundations of value investing that we reviewed before. We're then going to dive deep into publicly available data and create a research methodology, create a filter of how to think about value investments, identify potential candidates, and then step back and say, what does that mean for the next 3 months? In terms of following the show, if you do not recollect some of these previous episodes, if you want a general guide on how to follow the show, here is a link to a playlist. The playlist organizes every episode in order. Please feel free to go through that in order. And having said that, let us review something we have already looked at, value investing criteria. The way we think through value investing is start first with macroeconomics. Where is the economy? Is it headed to a recession? Is it in the growth phase? What about, pardon me, what about a particular sector or an industry? Are there a lot of substitutes in that sector? Is that sector price sensitive? We went through this a couple of episodes ago where we looked at an example of rock salt and said it doesn't matter what is happening in the world, rock salt always appreciates. And that was a very interesting aha moment. Unfortunately, there aren't that many publicly traded rock salt only mining companies. Otherwise, those would be wonderful to look at as a value investment. Now, the second thing we looked at is currency. Now, why did we even need to look at currency and how it affects supply chains and exports and imports? Only because of this debt ceiling stuff that is coming up in the US in July, where if you are an American value investor, you need to think hard about what could a currency crisis do? What could a debt ceiling crisis do to products or services that have a big export-import component? Let me explain that differently. We'll take something very mundane, eggs. The eggs you and I consume are, to a very large extent, produced locally. And so generally, egg prices, we'll call a dozen eggs $5. It could be higher, it could be lower, it doesn't matter. And egg prices during normal conditions do increase. There is inflation. It goes up by, 4%, 5%, 6%, and people complain, oh my God, egg prices went up. What happens when there is a debt default or currency instability? Let me say that differently. If you are the owner of a chicken farm and you have eggs you want to sell, the purchaser of your eggs gives you currency in exchange, which is not completely as stable, meaning the might of the government behind it, the purchasing power of the currency behind it is in doubt. And you are the owner of the egg. Would you want more of that currency or less? The answer is pretty simple. If the currency is unstable, you are going to want more per egg. In other words, the price of eggs will increase the more there is uncertainty around currency instability. Here is a link to an episode which talked about what happened in England to salad prices when there was a supply chain issue and when there were currency issues because of the Brexit situation that evolved there. There is also the same episode that talks about Pakistan, which is a very different economy, but they had currency instability and debt issues. Unfortunately, if the US were to ever stare down the barrel of a debt default, the commodity prices for things such as eggs will shoot up. When that happens, you as the customer will make decisions. You will say, hey, if eggs are $5 a dozen, we'll each have two eggs in our omelet today, me and my spouse and my three kids. If there are $25 a dozen, maybe we'll only give it to the kids. Maybe I'll eat something other than eggs. So the ability of a product to be substituted will control the price in the markets. And the grocery stores may see that you're not willing to buy eggs at $25 a dozen, and they may not carry it, and they may have empty shelves, which then drives down grocery store volumes. We saw some of this evolve. The reason I'm showing this is the debt ceiling crisis will have enormous impacts in the market. And so you as a value investor, you as a yield nerd need to think through how do you position yourself when it comes to where you want to be right before and potentially during the days, hopefully it never happens, but the days or hours or weeks that there is a debt ceiling crisis. So, how are we going to position ourselves? We are going to take the lessons we learned about rock salt, lessons we learned about eggs and currency, and look at publicly available data to identify more rock salt as a placeholder for items that remain the same, work the same, whether or not the country is in a recession. We'll then create a thesis, we'll narrow down our searches, and so let's get started. Where are we going to go? I'm going to suggest that you start at NAICS, and it's pronounced NAICS, and it's the North American Industry Classification System. So whenever a new business is created, if you're creating an LLC, if you're creating an incorporated, you are asked a question when you file that business, hey, what sector are you in? And so it's voluntary, but you still list a certain sector. And the reason companies will pick the correct sector is because a lot of contracts are dished out based on these codes, and you don't want to miss out on contracts that are applicable to you. So in general, these codes, even though they are voluntary, are fairly accurate. Then the NAICS organization presents it to you in a free database. You can go to naics.com/search, and you can literally drill down and say, well, one is agriculture, one is mining. Let me click on one of those. And when you click on that, you get to drill down. Here, I have clicked on manufacturing. 3.1 to 3.3 is every kind of manufacturing. 3.1.1.1 is animal food manufacturing. Within animal food manufacturing is dog and cat food, in which there are 600 odd companies, and every other kind of animal food where there are many more companies. But in reality, the two pets control a large percentage of animal food manufacturing. Then you can sit there and say, gee, I wonder who are the players in dog and cat food. You can click underneath there and it lists the top players in dog and cat food manufacturing. You can click into one more of these and you can then see that Mars Pet Care is a $2 billion business in just dog and cat food. And so you can kind of get deeper and deeper and deeper until you can understand every single company, their revenues, if they are public, if they are not public. So right here you can see, are they public or private? When did they start? Where are they located? And so it gives a very good individual deep dive. Well, what if you're looking for a broader analysis? You don't have to go company by company or industry by industry. You can go to naics.com custom market analysis profiles. And here is a free download of all of that data. How cool. So you can then download that and your data file is going to look like this. It is literally going to say by NAICS code, what does it mean? How many companies make under 500,000 in revenue? How many go from 500 to a million and so on and so forth? And here's what I did. I converted everything into a relative percentage within the category. So for example, turns out that if you're a goat farmer, there is an overwhelming odds that you make less than 500,000 a year. And nail salons and barber shops are not too far behind, although there are some other businesses that are farther to the right. The vast majority of them are under 500K, and there are X amount of uncoded records. So I generally look at this as noise. So remember to kind of look here. If this number is really high, then there is no point in looking at the right-hand side is the point. So now that we have organized it in this way and put relative percentages, remember the raw data is in absolute numbers. I created the percentages, and you're welcome to reach out to me. I will send you my modified spreadsheet where you can analyze it differently. And then you can dive deeper. One of the yield nerds, one of the subscribers here, told me a story about coin operated laundries and somebody that was in that business 20 odd years ago. And turns out 94% of coin operated laundries make less than 500,000, which kind of you sit here and go, you put a couple of quarters in there and push a button. And, how could that possibly be a big business? And, we'll leave it at that for a minute and start diving deeper. And then you sit there and say, is that a value investment? If you're in an apartment building and you don't have a washer or a dryer, and there are many two flats, many apartment complexes, well, then you're going to go to the coin laundry. Now, let's say that your apartment building takes 5 quarters for 28 minutes. Even if you knew that your friend's apartment a mile away took 4 quarters for 32 minutes, you are not going to take a load of laundry and go to your friend's house and go through the front. That's too much trouble. In other words, the number of available reasonable substitutes are very, very low. You are captive to using your coin operated laundry. You're not going to ship your clothes to another country. There is no supply chain risk. You also don't have a currency risk. You're going to pay a quarter, and that's the end of the day. And if you were to start a business like this 20 years ago, you are indeed meeting every one of the value investment criteria. Today, more and more people own their own washers and dryers. There still are apartment complexes that have a coin operated laundry, but the appeal of this business 20 plus years ago fits value investment like a glove. Very, very interesting. Well, here is the next part. If we dive deeper and said, gee, I wonder who is in that business, and then how big can a 25-cent, coin operated laundry really get? And here are a handful of companies. I clicked one of them, and it's $363 million CoinMark Laundry Corporation. How about that? Or you can go for somebody slightly smaller. Turns out this one is only $54 million. Mind-boggling when you think about a value investment business with a very small unit revenue. If you aggregate it, it has the characteristics of captive audience, not a lot of substitutes, not a lot of currency risk. You can build a very, very big company. All right, let's look at a couple of others. Excuse me. This time we're going to compare two. One is a flower shop or a florist, and the other is inland barges. We'll talk about both of them. If you were to look at it at a glance, they both have roughly the same percentage of companies that are below 500,000, and they kind of go from there on to larger companies. And you say, well, maybe they're both value investments. Let's apply a few tests. Let's take a florist and see what works. If we are in a recession where people are losing jobs, you're going through stress, of course, for Mother's Day, people are still going to buy flowers. But in general, if you're buying impulse purchases, would recessions lead to the same or greater impulse purchases? You do the math. If there is a cost escalation and a dozen roses cost $100, would you still buy it? You and I have seen that the price of a dozen roses have indeed increased. How often have you picked up a dozen roses just to pick it up and show that you're thoughtful? The frequency as the price of roses increase definitely decreases. It's a discretionary product, not a necessary product. There is another thing going on. Let's say you're buying tulips. Tulips are not grown in the US. Tulips have a currency risk involved with it. If there is a debt ceiling issue and the value of the US dollar shakes, all of a sudden tulips will cost $150. How likely are you to buy then? The point here is that the flower shop or the florist is not really a resilient market in terms of recession, and so they are not a good value investment. Let's talk about inland barges. What are they? If you need to ship something from the southern tip of the United States, say Louisiana, you just refined oil, it comes from Houston, and you need to ship it up the Mississippi River for consumption in the upper Midwest, for farming, for example. Or if you're shipping corn or wheat or other products that were farmed in the northern part of the United States and you need to put it down the river and take it down for export from the ports of Louisiana or that area, how do you get it up and down? You can put it in a whole bunch of trains. There's a loading cost, unloading cost. The cheapest way to do it, the safest way to do it, turns out, is an inland barge because they literally have their own dedicated highways. They just do their thing. You have a tugboat and you put it in a motor. You just literally can have a one-person crew or a two-person crew, and off goes the barge. And so an inland barge has that value investment criteria. In a recession, however, will we consume the same amount of oil? You do the math. Is there another alternative to moving goods along the Mississippi? If you want to move upriver and downriver in large quantities, I would argue there isn't. What about the alternatives for crop or oil to move? Is there currency risk for a US grown crop to move along the river? The price of the crop in the open market may differ. The ability to move up and down the river, there really isn't a good choice. There is one choice, the most cost efficient choice, and that happens to be inland barges. So let's dive deeper. I am going to go into a specific company only because that is the best way to understand this. I want to remind everybody I'm not recommending you buy or sell a stock. I'm only sharing my learnings. So if you dive one level deeper, you get a whole bunch of barge companies. And I'm going to dive into one of those, and that is Kirby. Kirby is the largest inland barge operator. Their investment presentation from 3.5 weeks ago is included here. They trade under the name of KEX, K-E-X, and here they are talking about their enterprise value. So they have a market cap of 4.2 billion. Not shabby at all for inland barges. How about that? And they call this net debt, which is really the total debt minus the cash balance. So market cap plus debt minus cash balance is what gives you enterprise value. And they have a debt to equity ratio of 25%. The industry average is 30%. But the real question is, do they have substitutes? Is the volume going up or down during a recession? And when you look at that, this is not rock salt. What I mean by that is during recessions, there is a significant decrease in revenue. And the reason being we ship less oil, the consumption is lower, there are fewer businesses, there are defaults and so on. However, it comes up extremely rapidly once we are out of a recession. And the point then is to apply the value investment criteria. There really are no good substitutes for inland barges. Demand and pricing does not look like rock salt, so they're not a value investment in that area. There is really no currency risk. Overall, it behaves like oil in the sense that it's a great value investment if you buy it at a low point in a recession, but if you buy it before a recession, you are likely to see decreases in value. So a very important point. So let's start taking the same example and applying it to a few others. Motor vehicle towing. If your car is beat up, inoperable on the side of the road, are you going to say, I'm going to start pushing it? Nope. Are you going to tie a rope and pull it yourself? Nope. You're going to call a tow truck. There really aren't a lot of substitutes. And so you also are far less likely to price shop. Some of us may sit there on the road and say, I'm going to call a bunch of people. Most of us call the insurance company. The insurance company says, we have somebody, we're sending them over, and the insurance company pays a fixed price, and you move on. If towing is not covered under your insurance plan, you're going to use whatever search engine you use, find a couple of tow trucks. You may call maybe one or two, but you're not going to sit there in the middle of the road with groceries in your car. You're going to move. You're not going to price shop a lot. There is also no commodity risk. And this is closer to rock salt in the sense that you're pretty much going to pay, give or take, what the local towing truck companies tell you is the price. And so then the question is, who are the companies in this sector? Again, I'm just sharing learnings. You do your own research. I'm not telling you to buy or sell a stock. And if you dive deeper, you can see that there are a bunch of companies. And one of them was right here, Miller Industries, and they make 500 million a year. They don't have a lot of debt. They have a very big market share. However, they are not the towing service. They make the tow trucks. What does that mean? Their customers may decrease purchases of new towing trucks during a recession. So it's possible, and you do your own research, it's possible that Miller will have softness in revenue and earnings during recessions. So you think through that and you make your own conclusion of whether they are a perfect value investment before a recession or only during a recession. Another very interesting example is pest control. So let's apply the test. If you have infestation of pests in your house, I suppose you can go apply the cheaper alternatives first, spray things that you buy at a local, hardware store. Let's say that does not work. You're going to need a stronger service. You're going to go to an extermination company or a pest control company. You may price shop, but maybe one or two, very much like towing. There is no currency risk. Again, it's closer to rock salt than inland barge, if you will. And so it's a great value investment in a recession, and it may be a great one even outside of a recession. Let's dig deeper. Let's go look at the individual companies. Again, I'm not recommending you buy or sell any of these. There are several billion-dollar corporations in this market. The main thing is when you look at each and every one of them and you see who they service, a good chunk of them service commercial real estate. And there is no doubt in anybody's mind that there is a lot of softness in that area. So you may want to look at each one of these companies, see if they have a lot of debt. If they have debt and their sales decreases, then their market cap is likely to decrease. It will have corresponding effects in their enterprise value. So be smart when you do research. I just wanted to educate you on the value investment sector. So remember the metric, enterprise value is the market cap, the amount you would pay to buy all the stock, plus the debt, because you have to pay off the debt. However, you get to take the cash in the bank, so you deduct that. So if you are to look for companies that match this criteria, which have great protection in terms of not a lot of substitutes, do well in a recession, then you are positioned to win in all likelihood. Until then, short-term treasuries are still the way to go. They pay around 5% for 3 months, which is phenomenal. Again, they are state tax exempt. The best step appears to be to sit tight, invest in short-term treasuries, wait for the debt ceiling drama to play out, learn about value investing, and get ready to rumble. Every spreadsheet I used here, including the NAICS codes and the percentages, I'm happy to share with you. Send me an email. Thank you for watching Yield Nerd.